LiteFinance, the world of financial freedom.
Hello, it's Monday, 7th of August, and it is time to start the market forecast, in which we will discuss all the most important macro events from the calendar and summarize current fundamentals that are driving the markets. And based on this, we will prepare a trading plan for this week for Euro-USD. Okay, so let's begin with the calendar. The start of the week is far from interesting. On Monday we will have a couple FOMC and Bank of England members' speeches, and on Tuesday only German inflation data will be worth paying attention to. On Wednesday we will get inflation data from China, which will help us assess the current situation in the second biggest economy. On Thursday we will get a final US CPI, and on Friday UK GDP figures. Okay. Now let's move on to US dollar fundamentals. And no matter how emotional investors reacted to the US employment report, the market situation did not change at all. Stocks are still falling while treasury yields are rising. Against this backdrop, the initial Euro-USD rise after the release of the news that non-farm payrolls did not match Bloomberg's forecasts and the downward revision of May to June data did not affect the overall situation. At first glance, employment growth of 185,000 in June and 187,000 in July indicates a cooling in the labor market, especially after a sharp slowdown in the indicator compared to the last year's 400,000 per month. Moreover, Atlanta Fed President Raphael Bostic reminded investors that it is important to pay attention to not to one or two figures, but to the overall trend. It is now descending, which allows Bostic to argue that no further increase in the federal funds rate is required. However, the decline in unemployment to 3.5% and the growth of wages by 4.4% signal that the Fed still has a lot of work to do. Fed official believes that to return inflation to the 2% target, wages should increase by approximately 3.5%. In accordance with the forecast of the Ministry of Labor, end of 2022 forecast an increase in employment by 55,000 per month is required to maintain unemployment at current levels. Perhaps the labor market is cooling, but not in the way that is required to prevent a new inflation high. The forecast of CPI acceleration from 3 to 3.3% in July confirms this. Thus, it is necessary to raise the federal funds rate, which is supported by FOMC official Michal. She voted for it to rise to 5.5%, looking at still high inflation, consumer spending, and a strong labor market that helps fuel prices. So the longer the Fed tightens monetary policy, the higher the risk of a recession. And 2/3 of the 410 investors surveyed by the MLIV polls believe that the recession will begin before the end of 2024, and 20% are betting on 2023, contrary to the forecast of the Fed. However, the stock and bond markets seem to have switched places. Previously, the rally in stock indices indicated that there would be no recession, but the current correction suggests the opposite. On the contrary, the growth of treasury yields indicates greater chances for a soft landing. However, it may be caused by a sharp increase in outstanding treasury debt, which needs new loans. So with the current US equity market conditions, don't expect a major USD weakening unless inflation slows down significantly. So the strategy of selling Euro-USD on growth against the backdrop of weak employment data worked out 100%. So hold short trades and add up to them in case of a successful breakout of supports at 109.75 and 109.96. Okay, and that will be all from my side. Thank you for watching, and till next time.